Hey, what's going on everybody? Welcome back to my channel and Happy New Year. I hope you've identified your 2020 financial goals and are well on your way to crushing them this year. Just like the title says, I sold over $1,500 worth of Apple and Tesla stock. And in this video, I will be going over why I decided to sell out of those stocks, as also showing you the exact amounts that I sold out of those companies. Then I will go into full detail as to how I went about deciding to invest in Pfizer. You'll want to stick around to the later part of this video because I go into full detail about how I go about making an informed decision to invest in this company. Let me know what you think down in the comments, what you think about Pfizer. Is it a good company? Is it not a good company? I just want to hear your opinion. And as always, if you like this type of content, make sure to hit the like button and subscribe down below to stay up to date with how my portfolio is doing. And before I get started, I want to say, don't go out and buy any of the companies that I talk about in this channel just because I buy them. You always want to make sure that you do your own research when investing in a company, because it is very important where you stick your money into for the long term. And with that being said, let's get started. So every 6 months or even once a year, depending on how my portfolio is doing, I like to rebalance out my portfolio because different companies grow and perform at different rates. Having too much of one asset and not enough of the rest of your assets creates an imbalance, which creates risk. You can never get rid of all the risk in your portfolio because after all, we're talking about the stock market and you can never predict what's going to happen. All you can do is minimize your risk as much as possible by making informed decisions as to where you allocate your money. So for me, 2019 was a super good year in the stock market, and it was time for me to take some profits and run because my Tesla and Apple positions did really good in the past year. Here I'm showing you a screenshot from December 31st prior to me selling out of those positions to show you how unbalanced my portfolio was. Apple was making up 27% of my portfolio with 45% gains, and Tesla was almost 20% of my portfolio with a crazy 71% gain. That's just simply too much exposure to two different companies, especially for the size of my portfolio. So I had to sell out of them just to rebalance everything out. Now for Apple, I ended up buying at a cost basis of $171.33 per share and sold at $293.65. That's a gain of about $122 per share. I ended up selling $969 worth of shares, which comes out to a little over 3 shares. Now I didn't sell that completely out of my Apple position because this is still a very profitable company. They also pay out their dividend that it's only going to get larger and larger as time goes on. And they also got some big plans coming up in the upcoming years, especially right now that 5G is gonna start rolling out. They also have their wearables business like the AirPods and the Apple Watches that are just bringing in lots of profit for them at the moment. So for these reasons, Apple is going to continue to grow and grow in the upcoming years, and they're going to be able to make me a lot of money in the upcoming years, which is why I didn't sell out of the company completely. So now let's take a look at Tesla. 2019 was a really good year for the company as they delivered a record number of cars in the third quarter of last year. They also completed building the Gigafactory out in China and started to produce cars out there, and they revealed their fully electric truck, just to name a few of their accomplishments. All these things contributed to my 71% gain in the stock. I had 3.3 shares with an average price of $248.25, and I ended up selling a little over 1 share for a total worth of $574.88. Again, with Tesla, I didn't completely sell out of the company because honestly, this company is just getting started. Each quarter, they're starting to grow a little more and more and getting more sales. The main reason why I sold out of it was because I was up 70% on my money, and Tesla doesn't pay a dividend. So I would much rather take some of those profits to reinvest it back into a different company that's actually gonna pay me dividends in this upcoming year. But like I said, Tesla is a company that I fully believe in that is going to bring me lots of money in the upcoming year and in the future. So if you want to know what I think about Tesla in full detail, I'll leave a video in the description down below where I go over my full bullish thesis on why I think Tesla will be successful in the future. So with those two sales, I had a little over $1,500 to play with. I could have easily cashed out that money and gone out and bought myself either some nice Jordans, a nice watch, or some other item that's not gonna put money back into my pocket Instead, I decided to reinvest that money back into a company named Pfizer, ticker symbol PFE. If you're not familiar with Pfizer, Pfizer is one of the world's largest pharmaceutical firms with annual sales of over $50 billion. Pfizer also spends a leading amount on research and development, close to $8 billion annually. While Pfizer historically sold many types of healthcare products and chemicals, now prescription drugs and vaccines account for the majority of the sales. I decided to invest in this company because I needed some exposure to the healthcare industry. But I didn't just pick this company at random. I did extensive research on the company's financial numbers to determine whether this was a smart decision on my part to invest in that company. And that is exactly what I'll be showing you now in the next couple minutes. Here's the data for Pfizer. I ended up buying 18 shares at an average price of $39.14 for a total investment of $704.54. There's a lot of numbers that make it seem confusing, but don't worry. I'll be pointing out the important numbers and explaining them in the simplest terms possible so you can understand. I got this information from Yahoo Finance, and as a dividend investor, the first thing I look at is the dividend yield. And for this company, it's a nice dividend of 3.88% with a payout of $1.52 per share. That basically means that for every share I own, this year I will get paid $1.52 divided into 4 payments because this company pays quarterly. The next thing I like to look at is how much cash they have on hand, because companies with a strong cash position are more likely to pay dividends now and in the near term. Pfizer has a little over $9 billion of cash sitting around, so I feel pretty safe and confident that they're going to continue to pay out their dividend as well as increase their dividend in the future. The next thing I like to look at is their dividend history. For the most part, their dividend payout has consistently increased over the past 20 years except for in 2009 and in 2010. This is around the time when the stock market crashed, so I'm assuming that has something to do with it. It's definitely not a good sign to see that they cut their dividend during a recession, but there's no black and white with investing, so that's just the risk I'm willing to take at the moment, because honestly, I'm getting this company at a good price. I also like to look at their payout ratio, which for Pfizer, it sits at around 49.65. You generally want to be cautious when looking at the dividend payout, especially when it's really high, out in the 80s or 90s, because that means that they don't have much room to keep increasing their dividend. You definitely don't want to look at a company that has a dividend payout over 100 or even more, because that means that they're spending all their profits in providing dividends to its shareholders. If their dividend payout is over 100%, that means that they're spending more money to pay their shareholders than there's actually money coming in. So it's very important to make sure that the dividend payout is low. Like for example, this one is at around 50%, which it means that they have a lot more room to keep increasing that dividend in the long term. One of the last things I like to look at is the company's PE ratio, or price to earnings ratio. For Pfizer, it has a PE ratio of 13.85. This basically means that you are paying, when you buy this company, you are paying around $13 for every $1 that the company makes. So when you see a company that has a PE ratio of 30, 40, 50, or 60, that means that you're spending a lot more money just to earn $1. So for myself, I like to stick to PE ratios between 5 and 25 to make sure I'm getting the company at a good price. Okay, so now you know a little better how I go about picking good dividend stocks to invest in. Keep in mind though that I didn't go over the full criteria as to how I go about picking stocks. There are things like positive cash flow, because you want to make sure that the company is bringing in more money than they're actually spending. Also, another factor would be their guidance. You want to know the direction that the company is headed in the future, and many other factors that I didn't want to talk about because I wanted to keep the video short with the most basic terms that you would be able to digest and understand. I hope this video brought a ton of value to you and you got to learn a little bit about dividend investing. If you got inspired and want to start investing yourself, there's a link down in the description where you can open up your M1 Finance account and you will get $20 free as soon as you fund your account with $100. So if you want to get some free money, go ahead and start investing. But as always, remember to do your own research. With that being said, thank you so much for watching, and I'll see you next time.